If you want to buy crypto out of your self-managed super fund, that's certainly something you can do.
Crypto is definitely an asset class that is on the rise. Certainly lots of guys have made lots of money in that crypto space.
If I had $300,000 in my super and my partner had $100,000 in their super, I'd be strongly considering opening up a self-managed super fund.
So I think the strategy does work. We've seen it for years. We've had clients doing this for a long time. And yes, this particular strategy does work long term.
Every young person in the country should be worried about this. Now, young people who accumulate more than $3 million worth of assets, and they will not have the same benefits that everyone else has had.
I think it's a little bit unfair to be taxing all of these hardworking retirees that have worked their whole life, contributed money to the tax system, and now they're asking these retirees to pay unrealized capital gains tax on assets they haven't even sold. I mean, gosh, what next? Welcome to SMSF Insider, where we help busy professionals to gain financial independence using an SMSF. Hi, I'm Troy, founder of Blue Chip SMSF Services. And over the last 20 years, I've helped thousands of Aussies manage the complexities of self-managed super funds. And in this podcast, I'll answer your questions, break down the myths, so you can take charge of your financial freedom. Let's get into it. Hey guys, just a quick disclaimer and just a reminder that this is not personal advice. So make sure you speak with a licensed advisor before making any investment decision. Hi guys, welcome to this episode of SMSF Insider. Today, I'm just going to be opening up a few social media posts and making some commentary around them.
Self-managed super funds suck, and for most people are a really bad idea, and I've unfortunately seen a heap of people that have got sucked in by people pushing self-managed super funds with an agenda and ended up seriously slowing down and sabotaging their progress. Self-managed super funds are typically sold with the allure of using your super money to invest into property, and
I guess to some extent we do see, I have seen a lot of this in the past where someone is pushing an SMSF for a certain agenda where they're trying to sell a property or they're trying to sell some sort of a marketing strategy. And SMSFs aren't for everybody, but certainly they can be a good strategy, or you can adopt good strategies with an SMSF. Having said that, you just need to make sure you're getting the right advice.
When you buy property through your superannuation fund, it's going to cost you about $10,000 in structuring costs. You've got to set up the self-managed super fund itself. You've got to register some company stuff in a lot of cases around that. Then you've got to also set up another, like a trust inside what's called a bear trust or a custodial trust inside your superannuation fund to own the property investments because of the super rules. And on top of that, when you then go and take out a mortgage on the property, you've got to pay thousands of dollars in mortgage application costs because there's very few players in the superannuation fund mortgage market.
What Ben Nash is saying here is somewhat correct in that there are definitely some upfront costs when establishing a SMSF and a bear trust. I don't know anyone that's charging 10 grand to set up an SMSF. It's probably a little bit on the steep side for just an SMSF. Maybe an SMSF with a bear trust, maybe, but even that's probably on the steeper side. But certainly for an SMSF with a bear trust, with corporate trustees, shouldn't be anywhere over that amount. So yeah, certainly if you're paying 10 grand for an SMSF and then paying on top of that for a bear trust, things are starting to add up, but you shouldn't be paying any more than 10 grand for an SMSF and a bear trust.
If you want to buy crypto out of your self-managed super fund, that's certainly something you can do. It seems like a good strategy because in a self-managed super fund, crypto is just a nice little asset class to think about. I tend to think it's a bit more of a long-term thing as well. So you build it up long term. If you do sell it in the super fund, the tax rates are going to be 15%. So therefore, I think it's an interesting way to actually invest. And often I've seen clients that have made really big gains in crypto because they bought in pretty early. And then when they've cashed crypto in, they've had a pretty big tax bill to go with it. So if you're doing it in a super fund and you've got some funds to do that, of course you can do it that way.
Yeah, so Chris has made a good point. Crypto is definitely an asset class that is on the rise. I mean, certainly has been for the last few years. Certainly lots of guys have made lots of money in that crypto space. Doing it inside your SMSF is a great way to accumulate wealth. There are some tips and traps, of course. Make sure when you're purchasing the crypto assets, or you're setting up the account, I should say, make sure it's in the name of the SMSF. And of course, yeah, it's a tax-friendly environment. 15% is a lot less than the 30% or the 25% outside of super, and certainly more than that in your own personal name. So yeah, it is a great way. And yes, we are seeing more and more clients in that crypto space or investing in crypto through the SMSF.
If I see one more person buying an apartment or a commercial property in their SMSF, I might cry. I have a very simple 4-step criteria to buying a property in the SMSF, so let me share it with you. We just bought this property for our client's SMSF for $645,000. The region that we bought in has an extreme supply shortage with only 2.2 months worth of inventory, which is very low. Meanwhile, houses are taking only 28 days to sell on market, which is 30% quicker than this time last year. This indicates high demand pressure and a supply shortage, which puts upwards pressure on house prices. Requirement number 2 is healthy cash flow, as keep in mind the SMSF needs to...
So yeah, we've got a few clients in this space that like a buyer's agent or buyer's advocates that that are, I guess, advising in the property space through SMSFs. So we've seen a lot of clients as interest rates started to rise, their serviceability outside of super became very limited. So we saw a lot of buyer's agents, or we saw a lot of activity start to come back to the SMSF space where clients have a lot of savings or in their super fund and having the ability to use that money to invest in property. So yes, we have seen quite a lot of activity in the space of buyers agents and buyers advocates advising clients in this space of purchasing property through their SMSF, and not necessarily, it doesn't have to be brand new property because there isn't a lot of brand new properties on the market. The limit supply is very limited in that space. So we do see a lot of buyers advocates, I guess, advising clients with established properties where the clients can actually purchase properties that are already established at that are undervalued in certain locations. Just quickly, guys, if you're a busy professional, fed up with traditional super funds and overwhelmed by the setup of your SMSF, we can help. Book in a call with my team using the link in the show notes, and let's build your future on your terms. Now, back to the episode.
If I had $300,000 in my super and my partner had $100,000 in their super, I'd be strongly considering opening up a self-managed super fund. Here's why. So when you open up a self-managed super fund, this will allow you to purchase an investment property. So you're able to put a 20% deposit down and the bank will lend you the remainder. The benefit in purchasing an investment property through your self-managed super fund is if you hold the property all the way up until retirement, so 60 and you've retired, you can sell that investment property completely tax-free. Another benefit is that all the expense.
So yeah, a great strategy. We see lots of this where we've got husband and wife or partners that establish an SMSF, so they're putting their retirement savings or their super together to create a bigger pool of money, and then using some borrowings to then enter the property market and invest in that property space. So Australian property is quite hot at the moment. There is a massive undersupply Australia-wide, so there is continued upward pressure in that particular sector, as well as having interest rates in the next cycle, in the downward cycle now. So providing a bit more confidence in both not only in spending, but also investing. So yes, I think the strategy does work. We've seen it for years. We've had clients doing this for a long time. And yes, this particular strategy does work long term if you're buying in the correct areas.
I'm about to make you $500,000 in 2 minutes, so listen up. Okay. You know your super fund, which is that 11.5% of your salary that goes away for retirement, and you've got your choice about who your super fund is with. Is it Australian Super? Is it CBUS? Is it Vision? Is it Aware? Whatever. Industry funds are great. Now, within each of those funds, you're going to have the choice as to how you want your super money invested, because it's just your money sitting inside the fund, but you could leave it in cash, you could put it in high growth shares, you could put it into international shares, whatever you like, right? Now, if you don't go into your super fund and make this choice, there is a default option which is called balanced. And what a balanced investment profile means is that, let's say you've got 100,000 in there, it means about 30% is going to be in what we call defensive assets or cash or bonds, but basically safe assets that can't lose value, but they're not going to grow either, right? And if you're nice and young and you've got a really long time before retirement, you don't need your profile in defensive assets. You don't need a balanced portfolio, but it's the default. Now, I want to show you the differences in the profile returns for high growth versus balanced versus defensive versus cash.
here we're talking about, this particular lady is talking about investing in different asset classes or different portfolios. So certainly, as when you're younger, the idea is that you have much longer time frame until retirement, so you can afford to be a bit more aggressive and have more exposure into those growth assets. So you've got time to ride out the peaks and troughs, because you're not actually going to be able to access those funds until retirement age. So as time goes on, you get closer and closer to retirement, your asset allocation becomes more and more geared towards defensive assets in the event of a downturn. So we do see that quite a lot. It's quite common in when it comes to asset allocation with younger clients, is to be a little bit more aggressive with their strategy because they have time on their side to ride out those peaks and troughs. And then, as I said, moving towards retirement, we see clients start to taper back their asset allocation back towards a bit more of a defensive portfolio, which so that in the event there is a crash right before retirement, they're not having to keep working for another 5 or 10 years to get their money back. So yes, definitely more aggressive in the earlier stages of accumulation phase, and then tapering back to more defensive towards the end, towards the pointy end, towards retirement. This particular lady is talking about more industry funds, but in the SMSF space, you can get access to higher growth assets through an SMSF. And when I talk about higher growth assets, that with higher growth comes higher volatility. So what I'm referring to there is assets like crypto, for example, that have high growth attributes, but also they're quite volatile, so they can also go the other way. But having time on your side, you have the ability to ride out any crashes in those particular asset classes. So yes, in industry funds, you can be geared more towards a higher growth portfolio, which is going to be more of the Australian international shares. You can also do that with an SMSF, have more high growth assets like Australian international shares and crypto and other asset classes. So obviously seek advice before making any investment decisions, but certainly you can have a higher growth portfolio with your SMSF as well.
Every young person in the country should be worried about this. And the reason I'll tell you why. Because every old person in the country has experienced building their superannuation up with only 15% tax rate from day one for the last 30, 40 years, since Keating introduced it in the early 90s. And we've had this, all of us had this fantastic low tax situation with the money we earn in our super fund. Now, young people who accumulate more than $3 million worth of assets, and they will not have the same benefits that everyone else has had since Keating introduced this legislation. Keating must be just feeling completely demoralised and probably to some extent betrayed.
What Mark Boris is talking about here is certainly correct. I love Mark. I love some of his content, and obviously he's had enormous success in business. But what Mark's talking about there is Division 296, which is a unrealized tax that's going to be introduced by the current government, where any super funds with assets over $3 million will be taxed at a higher tax rate. So what Mark was talking about there was that we've gone through this whole period of accumulating super when Paul Keating introduced the superannuation system, and we've only ever paid 15% tax, and now all of a sudden we're introducing a higher tax rate for balances over 3 million. Now, because the 3 million isn't going to be indexed, that means that everybody eventually will have 3 million in super, and everyone will be paying the unrealized capital gains tax. So they may introduce this tax into other areas, not just SMSFs, but they might introduce this to structures outside of super as well. So very unfair and a bit of a nasty one. Yeah, I don't know what to say. I don't know anyone that's really not opposed to this Division 296. What the Greens want is they want it reduced to 2 million. So That's going to capture a hell of a lot more super funds and obviously raise a lot more revenue. But I think it's a little bit unfair to be taxing all of these hardworking retirees that have worked their whole life, contributed money to the tax system. So they've paid income tax, they've paid GST if they've been in business, they've paid payroll tax, then they've paid contributions tax. And now they're asking these retirees to pay unrealized capital gains tax on assets they haven't even sold. I mean, gosh, what next? These guys are unbelievable. I honestly, I can't believe Australia's going down this route. And I won't be surprised if people start moving to places like Dubai and Singapore and all these other tax-friendly environments where they're encouraging businesses and have lower tax thresholds to be introducing a tax like this, especially to part of our community that worked their whole life and contributed to the tax system their whole life, and then ask them to pay an unrealized capital gains tax. Very unfair, in my opinion. Hey guys, thank you for listening to this episode of SMSF Insider. Please let me know what you think. If there's anything else you want me to, or if there's any posts you'd like to see me react to, shoot me a message and we'll include that in one of our upcoming episodes. Thanks for tuning in to this episode of SMSF Insider. If you got value from this, make sure you subscribe so you never miss the strategies we share to help you take control of your financial future. Find us on socials at Blue Chip SMSF or book a call with our team to see if we can help you.